In this video, you're going to learn two tools that professional traders use to fine-tune the exact moment they enter a trade. The first is the Fibonacci retracement, which most price action traders already rely on every day. The second is the optimal trade entry, or OTE, a concept that comes from ICT and the world of smart money concepts. At first, these two can look like they belong to completely different styles of trading. But by the end of this video, you'll see that they are really two sides of the same idea, and you'll understand how combining them can make your entries far more precise. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. To understand how to use Fibonacci correctly, we first need to understand how markets actually move. Price does not move in a straight line. It moves in waves because of the behavior of market participants. When buying interest is strong, price pushes higher. Eventually, price reaches a level where some traders and investors believe it is high enough to start selling, and that creates a pullback. If the buying pressure is still strong, many traders see that pullback as an opportunity to enter long positions. Then, the market starts moving higher again. This same process continues until the overall market sentiment begins to change. Impulsive moves are the strong pushes that drive price clearly in one direction. They are usually formed by large candles of the same color, showing strong momentum. Pullbacks, on the other hand, are temporary corrections that reveal hesitation or indecision in the market. They often include mixed-colored candles, smaller candle bodies, and visible wicks. But not all pullbacks are the same. Sometimes when buying interest is very strong, the market only retraces a small part of the previous move. At other times, price pulls back much deeper before continuing the upward trend. A shallow pullback usually shows that the trend is strong, while a deeper pullback can suggest that the trend is becoming weaker. In most cases, trends begin with strength and gradually lose momentum. Eventually, they reverse. Now, with all of that in mind, identifying where a pullback is likely to end and where the next impulsive move may begin can be extremely valuable. It helps us find potential buying or selling opportunities and participate in the trend with more structure. But how can we estimate where a pullback is likely to end? This is exactly where the Fibonacci retracement tool becomes useful. The Fibonacci sequence is a series of numbers where each number is created by adding the two previous numbers together. When certain Fibonacci numbers are divided by each other, they produce specific ratios that appear surprisingly often in nature. Now, what does this have to do with trading? These patterns often appear in nature because they represent efficient ways for structures to grow, expand, and organize themselves. Many traders believe that similar relationships can also appear in market behavior. That is why Fibonacci percentages are used to measure how much of an impulsive move has been retraced before the trend potentially continues. Now, why do Fibonacci levels work in trading? The main reason is not necessarily that markets are controlled by nature. In many cases, it is because a large number of traders are watching the same levels. As a result, many buy and sell orders can accumulate around those areas. Price reacts because market participants expect it to react. This is known as a self-fulfilling prophecy. In this example, the most recent impulsive move started at point A and extended all the way to point B. So, we apply the Fibonacci retracement tool from point A to point B. Now here is an important question. How do we know that point B is truly the end of the impulsive move? The answer is simple. We do not. If price continues moving higher, we simply adjust the Fibonacci tool to follow the latest move until a correction begins. The purpose of this tool is not to predict the exact top of the market. Its purpose is to measure the correction and identify where the pullback may end. so we can look for potential trade entries. But which Fibonacci levels are the most useful for trading? Let's go through some important concepts. Before we do, a quick word on notation. You'll notice that here on the channel, we write these levels as numbers, like 0.382, 0.5, 0.618, and 0.786, instead of percentages. Many traders know them as 38.2%, 50%, 61.8%, and 78.6%. And they are exactly the same thing, because 38.2% is simply 0.382, and 61.8% is simply 0.618. We prefer the decimal notation for one reason. It is the same language used by the optimal trade entry, or OTE, the precise smart money entry zone we'll build toward later in this video. So keeping a single consistent notation from start to finish makes everything much easier to follow. First, if a pullback does not reach the 0.382 level, we consider it market noise rather than a valid correction. So, in this example, we treat the move as one single leg and adjust the Fibonacci tool again. Second, in strong trending markets, pullbacks are usually shallow and often retrace between the 0.382 and 0.5 levels. However, this area is generally not the best place to take trades. The reason is simple. If we enter a long position inside this zone, our first target is usually the previous market structure high. Since price has recently reached that level, there is a higher probability that it may test it again before any reversal happens. At the same time, the safest location for our stop loss is below this recent low. The closer our stop loss is to that low, the better protected the trade becomes. Because of that, entering inside this zone often creates a poor risk-to-reward ratio, and in many cases, it is simply not worth the risk. We want our risk to remain small, while our potential reward is much larger. This 0.5 level also marks an important smart money concept's boundary. Everything above it is the premium half of the range, and everything below it is the discount half, an idea we'll explore in depth in just a moment. Now, let's move into the deeper retracement levels. The 0.618 level is known as the golden ratio, and the area between the 0.5 and 0.618 levels is known as the golden zone. This area is popular because price often reacts from it and then continues in the direction of the trend. Finally, we have the 0.786 level. This level usually offers the best risk-to-reward ratio. Your stop loss can stay relatively small while your profit target remains the same. However, there is one downside. You may miss many winning trades. In many situations, price never reaches the 0.786 level before reversing and continuing with the trend. So far, you've learned to use the Fibonacci retracement the way most price action traders do, as a flexible zone where a pullback is likely to end and the trend is likely to resume. But there is another group of traders who look at these exact same levels through a different lens, the ICT and smart money concepts community. Before we get to their precise entry model, we first need one key idea they rely on: knowing whether price is trading cheap or expensive inside a range. That is exactly what premium and discount are about. So, traders, what is premium and discount in the ICT methodology? And why does it matter when analyzing price inside a range? Within the ICT framework, price is not equally attractive at every level of the market. The location of price inside the range matters, especially when looking for higher probability entries and better risk-to-reward opportunities. That is where the concepts of premium and discount become important. But before we understand these zones correctly, we first need to understand what a trading range actually is. A trading range is simply the space between a swing low and a swing high in a bullish scenario, or between a swing high and a swing low in a bearish scenario. These swing points define the boundaries within which price is currently moving. Now, let us begin with a bullish example and understand how the trading range is drawn on the chart. In a bullish scenario, the trading range should be drawn using the Fibonacci retracement tool, with the 0 level placed at the swing high and the 1 level placed at the swing low. This means the upper boundary of the range is defined by the swing high, while the lower boundary is defined by the swing low. Once the range is established, the area above the 50% level becomes the premium zone, while the area below the 50% level becomes the discount zone, These zones help traders evaluate where price is positioned within the current market structure. Once the trading range is established, if price moves higher and breaks above the previous swing high, this creates a break of structure, confirming bullish continuation. On the other hand, if price continues moving lower instead of breaking higher, the market may begin forming a change of character. So, the key idea is understanding the sequence inside the trading range. First, the range is established. Then, a retracement forms. From there, the market reaches a decision point. Once price breaks above the trading range, we begin identifying a higher low and a potential higher high as the bullish structure continues developing. This is why it is so important to learn how to mark the trading range in real time, instead of only studying static examples after the move is complete. As price evolves, the trading range must also be adjusted according to the developing market structure. However, within the ComLucro framework, the range only becomes fully fixed once price delivers a valid retracement, specifically reaching at least the 0.382 level, which is one of the criteria we use to define a valid pullback. At that point, the structure becomes more clearly established, allowing us to properly define the higher low and higher high on the chart. Until then, while price continues expanding upward, the trading range remains dynamic and adapts to the developing price action. Now, the same logic can also be applied in bearish market conditions. In a bearish scenario, the trading range is drawn from the swing high to the swing low using the Fibonacci retracement tool, with the 0 level placed at the swing low and the 1 level placed at the swing high. The area above the 50% level becomes the premium zone, while the area below becomes the discount zone. When looking for long trade opportunities, we generally want price to trade within the discount zone, assuming other factors support the setup. The deeper price moves into the discount area, the greater the potential risk to reward ratio becomes, especially when a stop loss is placed below the swing low and the target is positioned near the swing high. In bearish market conditions, traders typically look for short opportunities within the premium zone. The higher price trades into the premium area, the better the potential risk to reward ratio, especially when the stop loss is placed above the swing high and the target is positioned near the swing low. Now that you understand premium and discount, we can bring in the tool that puts them to work with pinpoint precision. Smart money traders take these very same Fibonacci levels and turn them into a much more specific entry model, and they give it a name: the optimal trade entry, or OTE. What is powerful is that OTE is not really a new tool at all. It is built on the very same levels we just covered, combined with the premium and discount idea we just explored. And because we've used the decimal notation from the very beginning, everything you already know carries straight over. So let's see exactly how the smart money side uses Fibonacci to define its optimal entry. So traders, what is OTE in the ICT methodology, and how can it help identify higher probability trade entries? OTE stands for Optimal Trade Entry. It refers to a specific Fibonacci retracement zone that aligns with discount for long trade entries and with premium for short trade entries. The idea behind OTE is to refine entry timing by focusing on areas where price is considered optimally priced within a range. It is important to note that ICT's original teachings define the OTE using the 0.62, 0.705, and 0.79 retracement levels. However, at ComLucro, we prefer to use the traditional Fibonacci retracement levels of 0.618 and 0.786, while still recognizing the importance of the 0.702 midpoint. We believe that using the classical Fibonacci levels increases confluence, since these levels are widely followed by traders across different methodologies and markets. Before applying the OTE, it is important to correctly configure the Fibonacci retracement tool. In a bullish scenario, the 0 level should be placed at the swing high and the 1 level at the swing low. In a bearish scenario, the 0 level should be placed at the swing low and the 1 level at the swing high. Regardless of how the Fibonacci is drawn, the premium zone will always be located in the upper half of the range, while the discount zone will always be located in the lower half. The position of the Fibonacci levels may change, but the concepts of premium and discount remain the same. So, that is the optimal trade entry, a way the smart money side turns a simple Fibonacci retracement into a precise, rule-based entry. And a quick note on how we'll use it here on the channel. From this point on, when we mark an OTE, we'll use the ComLucro reference, the traditional Fibonacci levels 0.618 and 0.786, while still recognizing the importance of the 0.702 midpoint in between. So from here on, whenever we mark an OTE, those are the exact numbers we're referring to, and we're about to put them to work in two practical strategies. Now that we have covered the key ideas behind Fibonacci levels and the OTE, it is time to move into a practical trading strategy with clear entry and exit rules. The first strategy is a simple but powerful trend continuation setup that combines market structure with Fibonacci retracement levels. Open any chart on TradingView. Step 1 is to identify the trend by marking the impulsive and corrective moves. If you cannot clearly identify a trend and the market looks choppy or unclear, simply close the chart and look for another pair. This strategy works best in clean trending markets. If the market is in an uptrend, we only look for buying opportunities. If the market is in a downtrend, we only look for selling opportunities. Step 2 is to identify the most recent impulsive move and apply the Fibonacci retracement tool from the beginning of the move to the end of the move. Next, place a buy limit order at the midpoint of the OTE, the 0.702 level. Place your stop loss below the recent swing low. Once price reaches the first target, close half of the position and move your stop loss to break even. This makes the remaining part of the trade risk-free. The logic behind this setup is simple. Deep pullbacks are very common in trending markets. By entering inside the OTE, the zone between the 0.618 and 0.786 levels, we enter earlier and at a better price. The stop loss is placed below the recent swing low, because a break below that area would invalidate the uptrend. The first profit target is conservative and has a strong probability of being reached, allowing us to secure partial profits while giving the rest of the position enough room to continue. The second take profit target is the next important level ahead of price on a higher time frame. However, before entering any trade, we need to confirm that price has enough space to move. If you switch to a higher time frame and notice that price is already inside or very close to a higher time frame supply zone, that area can trigger a reversal and stop us out. That is why we only take trades when there is enough distance between our entry and the nearest higher time frame supply or demand zone. Now, you might think this setup is too simple to work, but remember this: more confirmation does not always mean a safer trade. Many times, it simply means you are entering too late. Now let's look at a real chart example. Here we have gold on the 1-hour chart. The market was previously in a downtrend, but the latest move failed to create a new lower low and then broke above the previous market structure. This suggests that market direction has shifted bullish, so we can begin looking for buying opportunities. Here is the beginning, and here is the end of the most recent impulsive move. Now we can apply the Fibonacci retracement tool to measure the potential pullback. Our expectation is that price will retrace, find support somewhere inside this range, and then continue moving higher. However, as the strategy suggests, we will use a conservative entry. We place a buy limit order between the 0.618 and 0.786 levels of the OTE. The stop loss goes below the swing low. The first take profit target is placed a few pips below the recent high, while the longer-term target can be the next major turning point in the market. As you can see, the trade reaches our target and becomes a winning trade. Price then creates another impulsive move, breaking market structure to the upside. Once again, this gives us another opportunity to apply the Fibonacci retracement tool and place a new buy limit order. Let's move the chart forward one more time. This time, price does not reach the 0.618 level, so our order is not triggered. And that is completely fine. Not every setup will become a trade. We simply wait for the next opportunity. It is also important to understand that retracement levels can be combined with other trading concepts to create different types of entries. In the next section, I will show you a powerful strategy that combines Fibonacci levels with price action concepts. Strategy number 2. To begin, we need to identify a major market structure level. This level will serve as our key point of interest and the area where we will look for potential trading opportunities. But what exactly is a major market structure level? A major market structure level is an area where price has been rejected multiple times, has acted as both support and resistance, and has been respected recently. These levels are extremely important because they often provide some of the highest probability trade entries. Here we have a major market structure level. If price retraces back into this zone, we can anticipate another possible rejection to the upside. However, we are not going to enter a trade based only on this level. We need additional confirmation that buyers are stepping in and that the level is likely to hold. So, let's zoom in one time frame lower to find that confirmation and look for an entry on the lower time frame. The confirmation we are looking for is the formation of a double bottom rejection pattern. Double bottoms and double tops are powerful reversal patterns. When a double bottom forms at a key demand level, it signals a potential bullish reversal. Likewise, when a double top forms at a key supply level, it signals a potential bearish reversal. This happens because price has tested the level twice and failed to break through it, showing that buyers or sellers are defending the area. However, we should not enter the trade immediately. We must wait for price to break through the neckline to confirm the double bottom pattern. Once the breakout is confirmed, we can enter the trade with much greater confidence. Now, in this example, we have a double bottom pattern forming at a higher time frame demand zone, which signals a potential buying opportunity. However, at this point, we are already too late to enter the trade. No matter where we place our buy order right now, the stop loss would still need to be positioned below the swing low to protect the trade from normal market fluctuations. This would create a very large stop loss and a poor risk-to-reward ratio. Instead of chasing price, we need to wait for a pullback that allows us to enter at a better level. This is where Fibonacci retracement levels become useful. By applying the Fibonacci tool to the latest impulsive move, we can identify potential support levels where the pullback may end. According to our strategy, we place a buy limit order at the 0.618 level of the OTE. If price retraces into this area and finds support, our order will be triggered, and we will enter the trade at a much more favorable price. Now let's look at a real chart example. Here we have euro-dollar on the 1-hour chart. If I draw a zone around this area, you can see that price has repeatedly reacted to it as both support and resistance. This tells us that it is a major market structure level that market participants are watching closely. Recently, price broke below this level and then pulled back into it. Based on this behavior, we expect that the level may now act as resistance and that price could continue moving lower. However, before entering a trade, we want additional confirmation that sellers are actually stepping into the market. To do that, we can zoom in to a lower time frame and study the price action more closely. Let's move to the 5-minute chart. On the 5-minute chart, we can see that price has formed a double top pattern, which is an early sign of a potential reversal. However, the pattern is not confirmed yet. To validate the setup, we need to see price break below the neckline. If price continues pushing higher and the neckline break never happens, then there is no trade. So, let's play the chart forward. As you can see, price breaks below the neckline, confirming the pattern and increasing the probability of a move to the downside. Even so, we still do not want to enter the trade immediately because the stop loss would be too large. Instead, we wait for a pullback. We apply the Fibonacci retracement tool to the most recent bearish impulse and place a sell limit order at the 0.618 level of the OTE. The stop loss is placed above the swing high, and we target the next important level ahead. As you can see, Fibonacci retracement levels are a simple but powerful tool for improving trade entries. Instead of chasing the market after a move has already happened, they allow you to wait patiently for price to come back to you and offer a more favorable risk-to-reward opportunity. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.